Hi, I'm James Dunn. Welcome to the Inside Network. Welcome to INDepth, and my guest is Co-Chief Investment Officer at Talaria Capital, Hugh Selby-Smith. Welcome, Hugh.
Thanks for having me.
It's a pleasure. Hugh, it'd be really good, I think, to kick us off with a description of how Talaria came to be.
Talaria was originally founded in 2005, and we've run the same strategy, single strategy, unchanging since then, so we're in our 16th year. It's a global equities fund. Originally it started under the Wingate Group. I've been very supportive of my co-CIO, Chad Padowitz, in founding the strategy. And in 2018, senior management effected a management buyout to become the majority owners of the firm.
And what's the strategy aimed at in terms of sectors and capitalisation levels?
There's no sector-specific kind of targeting. What we're looking for is companies that are attractively priced, ultimately, to generate a good return. In terms of market capitalisation, we typically work on an average daily turnover rather than a capitalisation per se. Minimum daily turnover is $30 million per day. That equates to around about $5 billion of which there's about 2,800 companies globally. In terms of our universe that we can invest in.
And do you look at head stocks wherever they are, or do you prefer to use ADRs, for example, if they're not US companies?
Our implementation process is such that every equity we own starts life as a put option. So whilst we're looking at every geography and country in the world outside of Australia, they must have a developed market listing because that's actually where the options reside. So in that case, we'd always be in an ADR or obviously a London listing as well.
A swathe of dividend cuts in Australia has really impacted on retirees' income. So what, in your view, is the solution to that growing income challenge from that perspective of a retiree?
I think it's incredibly difficult. I mean, asset prices across a whole swathe of different sectors and asset classes are, of course, incredibly high. So the income return is depressed. The first thing is you need to be able to diversify across asset classes, across the way that money's invested, but also within region and across sector. I think the bottom line is that it's incredibly challenging to get a sufficient income return without taking too much risk. Now, there's three areas I think that come to mind just as a rough example, which would qualify as that diversification. Firstly, we're seeing growing interest in private debt markets. There's a lot of companies, businesses and individuals that are relatively creditworthy that, for really reasons driven by macro-prudential standards by the regulators, are finding it difficult to access credit at the headline market rate. And that means that they're actually looking to private credit markets to be able to fund that gap. And we're seeing a growing host of those offerings in Australia, but also globally. So that would be one thing. I think secondly, you can look to diversify. Japan, for example, is an interesting area, a terrible relative investment market over the last 40 years because of the starting valuations. But on a relative dividend yield, it's got actually quite attractive now. And those dividends are very strongly backed from a capital strength perspective. So I think that's a second example. A lot of people aren't looking at that market because traditionally it was been so poor. There's also some corporate change action there, and also there's a mindset change that should benefit shareholders in aggregate as well. And then the third thing is the equity insurance market. That is really a function of using options and derivatives to generate an income, a smoother journey. So those are three things that would come to mind. But I think the issue is a real one for retirees and a difficult one.
And Australia's been a market where, because of the tax advantage nature of franked dividends, particularly as your tax rate decreases in retirement, depending on when you pension phase, for example, of a self-managed super fund, the zero tax, the yields can start to become very, very large. But people run capital risk for that, don't they, Hugh? And that's not well understood.
No, I think that's absolutely right. I mean, dividend yield as a strategy and as a factor per se has a number of relative weaknesses. One, it actually suffers a lot more in periods of risk off or drawdown in markets. We saw that in 2001 to 2003, 2007 to 2009, and we saw that in the recent kind of pandemic-induced drawdown of last year. So that's the first thing. The second thing is it's a lot more volatile in terms of those companies that have an above-market dividend yield. They have weaker balance sheets. And ultimately, dividends, in many cases, are really paying out amounts of capital that are unsustainable. And we've seen that, obviously, perhaps best example is Telstra in Australia, where they got to a situation where they had to reduce the dividend. So I think your point is absolutely right. The search for yield, in many instances, is an outcome that's targeted that results in people putting capital ultimately in poor places in terms of a risk perspective.
And can result in companies not investing sufficiently because they may be too worried about maintaining a dividend level at a certain rate.
Absolutely right. I mean, I think one of the best examples of that for a very long time in Europe was the mega cap oil sector. So Royal Dutch Shell famously last cut their dividend before the most recent pandemic-induced cut when Germany rolled into Amsterdam in 1942, and they became a slave to the requirement to continue to grow and pay out and maintain a very high dividend yield. And that was ultimately a poor management decision in terms of capital allocation and the requirements for the cash into the business.
How do you balance risk and reward in a global equity strategy, particularly given that 2020 and 2021 have been very, very turbulent?
Yeah, I mean, that's the core competence of any fund manager, I mean, or investor, be that individual or institutional. I think the first thing is you have to recognise as an equity holder that you are subordinated in the capital structure. And that means putting an emphasis on, will I get paid back? The reward function is really about how long you have to hold the money to get your money back. And so I think those two things can be disaggregated. We would always advise people, and our process itself starts with the balance sheet. Now, clearly over the last decade, but even over the last 40 years since the peak in US interest rates in 1982, there's been pretty one-way traffic about ever cheaper debt finance, ever cheaper, ever more abundant liquidity. But that does not mean that ultimately that the capital structure of the company that you're investing is healthy. I think at the macro level, you only have to go back to Australia in the relatively early 80s. The percentage of the tax take just being paid out in servicing the debt was incredibly high. So it's easy to get a little complacent about the idea of the interest charge as a percentage of the revenue, as opposed to the potential leverage that you get if there was a changed environment.
Let's move on to the derivatives aspect of your strategy, because derivatives and options are widely misunderstood. It seems that, like so many things, they can be, in the wrong hands, a recipe for disaster, but in the right hands, used judiciously by people who know what they're doing, they can be very, very handy. So how do you use them to manage risk and augment returns?
So every equity we own starts life as a put option. So we sell a promise to buy a stock at a price lower than the current market price around 2 months in the future. There's no leverage involved, so the amount of our total stock exposure, were we to take possession, is fully cash backed by money moving across into the bank account. And for providing that promise, we get paid a premium. So stock trades at $100, we commit to buy it in 2 months' time at $97, and for providing that commitment to buy a share we want to own, we get paid $3. Only two things happen come 2 months' time. Either the stock's trading below $97, in which case the cash that we've been putting aside to pay for the stock we want to own moves across, and we take possession of, say, 1% of the portfolio in the stock that we want to own. Our effective entry price in that is $94. So we got paid $3 for providing that commitment. Or simply the stock's trading above $97 in 2 months' time, in which case actually the cash is still the cash of ours, and we keep the $3. So in either instance, actually we keep the $3 premium. Now that generates some differentiated outcomes for our investors. Firstly, we have a distinct and differentiated source of income that is not dependent on a company's ability to pay a dividend, whether it's sensible, management discretion, but is in itself actually a reflection of wanting to buy the share. The second thing is it actually lowers the downside risk structurally of the portfolio. So as markets move lower, clearly we don't take that first 5, 6, 7% of movement. So that means that we have more money working for us in the ups, and we slowly get more and more equities in the portfolio as they get cheaper and cheaper, which is obviously what you want. And the third thing is that it really smooths out the volatility of the market because you've got a contracted rate of return on a portion of our investors' capital for a rolling 2-month period.
Inflation's clearly a growing risk to markets, and the implication of higher rates on equity valuations is reasonably well appreciated, but less so the impact on yields. So do you think that's something investors should be more concerned about than they are?
They should certainly be cognizant of it, and I'd really think about two things. Firstly, a dividend yield is really the additional excess cash available to distribute to shareholders. To keep up in real terms, were inflation to move structurally higher than we've seen over the last decade, then clearly the company that you're receiving a dividend from needs to have a strong degree of pricing power to push through the inflation that would go through their business. I think secondly, at the big picture level, clearly it will challenge some companies where a whole range of listed equities are relatively highly indebted. Were the inflation outlook to change, then clearly the financing needs from interest charges, having to refinance that debt at higher rate would also actually pressure management in terms of their capital allocation decisions between rewarding shareholders and having to keep the business in strong financial health.
This has been INDepth, and my guest has been Hugh Selby-Smith, Co-Chief Investment Officer at Talaria Capital. Hugh, thanks so much for your time.
I've really enjoyed it. Thank you very much.